Follow at But Would You and you'll be alright. What's going on? What's going on? What's going on, family? I appreciate you guys checking in. Today, I have my good friend Danny Giblin join us to do a macro talk. So last week we spoke with Winston. Today we're going to be speaking with Danny in regards of interest rates, recession looming, and just a little bit of the greater macro picture. And we're also going to be going down some more in-depth and easy to understand explanations about some of these terms and their cause and effects that you may not know, right? So I'm very happy that my friend Danny was able to join us today. So please welcome to the stage my good friend Danny Giblin. What's going on, my brother?
I appreciate that intro. Oh man, I'm doing good. How are you doing, bro?
I'm doing phenomenal. I really appreciate you coming on and talking with me. So yeah, I had to give the hype intro for the hometown hero. One of my good friends. For the people that don't know, Danny and I both grew up back on the East Coast. So he was always schooling me to the game when we met when we were both working at a restaurant actually. And Danny was pursuing his MBA, and so I was always trying to soak up the knowledge from him. He would drop the financial facts for me, and he loved talking about it. So I was figured, hey, here we are 10 years later. Why don't we do it in front of the world? So
why don't we talk about it?
All right. So I guess, yeah, let's get into it, man. So what are some of your thoughts on this macro market? I guess some of the key points that recently were announced were your boy, Jay Powell, raising up those rates, the highest interest rate rates in 28 years, I believe. So that's some pretty big news. So I guess let's start from the beginning, right? That's always a good place to start. Could you tell me, what are these interest rates that Jerome Powell is raising? Like, when you think of an interest rate, I guess a normal consumer might think of like, oh, I have an interest rate on my credit card, right? If I have a $100 limit on my credit card and I have a 15% interest rate, if I spend that $100 and I'm at my max capacity, I'm going to get charged 15% interest on that $100 that I spent. So, I'd have to pay $15 as a fee for interest rates. That's, I would say what a normal person would think with interest rates. But what are the interest rates that Mr. Powell affects?
Yeah, so I do want to say that the easiest way to wrap your head around some of these concepts is to think about it on like the individual level, because you can relate to that the most. So you're right. So, interest rates, an interest rate is just the rate of interest you pay on borrowed money, right? And it's quoted in terms of what you're paying relative to the principal, right? So if you borrow $100 and the yearly rate is 15%, and you're only going to be paying that, once, at the end of the year, then you're going to be paying back 15% interest. I mean, $15 worth of interest and the $100 principal. So that's essentially how a bond works too. All these bonds and a lot of these debt-related financial products, it's the same thing. It's borrowed money, and when money's cheap to borrow, that's in place to stimulate economic activity. So right now we're seeing that to control inflation, right? So we saw, the highest rate increase in how long did you say? A while, right?
75 basis
points. 28 years. Okay, so yeah, and so what they normally do is Jerome Powell's the chairman of the Federal Reserve. The Federal Reserve is the central bank of the United States. Their job is to control inflation, and they do that mostly in part by influencing interest rates, right? So when you hear about this 0.75% increase, that's actually an increase of what's called the federal funds rate. So the federal funds rate is the rate that banks loan money to each other overnight. And they do that because banks operate on fractional reserves, right? So they have reserve requirements that they have to hit every day, right? And say they take in $100,000 in deposits, and the reserve requirement, which is set by the Fed, right, is 10%. Then they have to have at least $10,000 worth of cash on hand.
So I have a quick question. I have a quick question. I don't want to lose that train of thought. You were absolutely killing it right there.
No
so fractional reserves, right? For the people that may not understand that, just like Danny was saying, a fractional reserve. If you have, what'd you say the rate of fractional reserve was?
It's 10 to 15%
So let's say
historically.
you have
Yeah.
a 10% fractional reserve. So if I'm a bank and I take in $100, right, I can go use $90 to go try to make other money, right? So you can deposit $100 into my bank. I can go use $90 of that. All I need to do is just keep 10% of that 100. So in essence, I only have $10 in the actual bank, and I'm using the $90 to go make more money. Correct?
100%. Yeah. So that's how banks will make money, right? Is they pay out a very small percentage on consumer deposits, and they loan it out for generally a longer period of time in the form of mortgages and car loans. And say they're paying 0.5% on a deposit. And they're loaning that out on a car loan, making 5%. Then the banks are profiting all fees and everything taken out of 4.5% on that loan.
And that's the
So
spread, right?
100%, that's the spread. Yeah. So when banks, when it costs a bank more money, or it costs them a higher interest rate to borrow money from other banks or the Federal Reserve, what is the bank going to do to make sure they remain profitable? If they're borrowing at a higher cost, they're going to make sure that the customers are borrowing at a higher cost. And that's when you start to see mortgage rates go up, which is the biggest interest rate that's tied to these things, right? Like, when banks do create, money into the economy through these loans, it's the majority of it is through the real estate market, right? But there's obviously other various things. But that's when you hear about the housing bubble that kind of happened in the late 2000s. A
Okay,
lot of
okay.
the
So
talk
wait,
was
before
about the
we
interest, the mortgage rates. So yeah, what's up?
yeah. So just before we get too far ahead of ourselves, we've done a great job catching up so far. So just to be sure, I just want to clarify, make sure everyone's following along. So we know that the Fed will increase interest rates, right? And so we discovered that what does that mean? That means that the Feds are increasing the rate, the price, essentially, for banks to borrow money.
Yeah, yeah,
And
exactly.
because they're increasing that rate for banks to borrow money, the banks aren't going to take on that financial burden. They're going to pass it on to the customer. And so that means that if the bank's federal interest rates are increasing, then your interest rates are essentially increasing, correct?
Absolutely, yeah, yes.
Okay, so that's the domino effect. So we figured out, ladies and gentlemen, we can all become rich now. If you didn't know, I'm just kidding. I'm just kidding. But I do try to start from the basics and explain it the best way possible for everyone to get a good grasp on it. Because without really fully understanding these essentials, it's hard to dabble inside of the crypto world or the traditional finance world. So I just really wanted to go through that and make sure we broke it down properly. So okay. Good. So that's the interest rates, and like you were saying, that led to in 2007 interest rates being increased, which turned to the mortgage rates being increased, which turns to a housing bubble and the eventual housing bubbles collapsing. Correct?
Yeah, exactly. And there's a lot of other factors that caused like those adjustable rate mortgage rates to go up, right? There was a credit crunch, and what you find out in economics and finance is that all these things are interrelated, right? Nothing's in a vacuum. To understand certain concepts and wrap your heads around them, you do got to try to think of them in a vacuum so that you understand how that operates and what's its means of existence is, right? But you got to understand that in finance and economics, everything's affecting everything, right? But yeah, so the interest rates did go up, and there was a credit crunch. A lot of people's mortgages rates went up. They couldn't
And
afford
so
the payments.
could you explain what a credit crunch is really quick?
Yeah, so a credit crunch is when there's more strict standards to where banks like who and how much money banks will loan out and for what reasons, right? So a lot of times banks when there's a lot of uncertain economic conditions, banks are going to be cautious and they're not going to lend as much money out because there could be this counterparty risk, and and there's all these different reasons, and there's risks of default, right? So banks want to keep cash on their balance sheet, right? They don't want to go insolvent themselves, which we've seen in the late 2000s. There was a lot of commercial banks and investment banks that were going out of business, and we had some of the biggest banks in the world that had to get bailed out by our government, which we all are probably well aware of if you're in around the same age as us, right? Because that was in the news at that point, right? So, but going back to Jerome Powell and all this news now, right? I think a lot of inflation, the recession talk, a lot of that's on the forefront right now, because there's a lot of people that lost money in the stock markets and the crypto markets, unfortunately, very recently. And you hear all this talk. You hear about inflation. You hear about these interest rates being raised, and especially me, like I've always been someone that if I had the means to look into something and understand it and learn it, I kind of would. So when you hear about the CPI going up 8%, and that's a measure of inflation, and that's tied to interest rates going up, which is the reason financial markets are losing money. That all relates to us personally. So yeah, what we're seeing right now is due to the high inflation, which can, in a vacuum, be attributed to an increased money supply, right? We have between the pandemic the past couple of years, and then compared to the real estate crisis and in the late 2000s, there's been a lot of measures that has thrown monetary supply through the roof, and an increase in money means that it's less valuable, which means it takes more money to buy certain things, and that's exactly what inflation is. And with the raise of interest rates and the worrisome talk about inflation, that's when you start to see people panic selling, and it kind of trickles into these financial markets, and there's sell-offs, right? So that's what we've seen, especially the past 6, 7, 8 months. Is we've had inflation triggered sell-offs because there's perception that we might be going into a recession, which these things are cyclical, and there's a lot of indicators that would support that, but nobody knows for sure what's going to happen and when it's going to happen. It's it's important to kind of just have as much knowledge as you can on the topics so that you can kind of make decisions for yourself.
Yeah, I 100% agree. And like we were speaking about earlier, like here's just a few slides that I looked into the Google Trends just to see like, oh, like what are people like talking or looking up, or what's the thought process behind a lot of people right now. So some of the upticks in trends were just the mortgage rates, the interest rates, recessions, as well as bear market are some of the biggest Google things over the past few months. The highest being recession. So people are definitely worried about recession. And then I also just took into account the interest rate right here. Back in April, beginning of May, end of April, beginning of May, interest rates really took a high tick up, and people just trying to figure out and understand what they are. So I really just was really happy that you came on so that we could kind of touch on what all these things mean and how they're all correlated together, right? So that was a lot right there. But basically, kind of like a quick summary, right? You have the fact that money was printed into the system in 2020 due to the pandemic. So that caused an increase in supply. So more supply onto the markets, as well as having low interest rates, aka cheap money, because it was very low cost to borrow that money, and a low barrier of entry for people to be able to get those loans. So as all that money and that increased supply came into the market, eventually it caught up with us, causing inflation. And the way to combat that inflation is to increase these interest rates, because when we increase these interest rates, that gets put onto the banks, which gets put onto the customers, basically saying that, hey, don't borrow money right now. Money is expensive right now. It's going to slow down the economy. But in doing so, slowing down the economy can in turn lead into a recession. And I know, I've heard it all over so far. Oh, a recession is just 2 negative quarters of GDP growth, and so on and so forth. So, is that kind of a overall summary of the position that we're in now?
Yeah, 100%. So we've seen the interest rates rising, right in correlation with the reported inflation going up, right? I mean, when you look at historical inflation rates in our country, it averages between 3 and 4% per year, just every year, right? And that's natural, right? When you have population growth and you have this expansive economic activity, inflation is just gonna happen. So that's why the central bank exists, is to kind of control and stabilize prices and make sure inflation doesn't spiral out of control. So by raising interest rates, one thing you find out, I guess, in undergraduate finance is that price rules everything, right? And then in the more
Price rules
advanced,
everything around me.
price rules exactly. I mean, the examples one of my professors used is that he says, I don't need a Ford F-150, but if you're going to offer me a brand new one for $2,000, I'll take 10 of them, right? Price rules everything. And then you actually find out that, more in depth is that interest rates affect and they control everything. You can relate interest rates to a lot of things, and that's just the price of borrowed money, right? And when you think about interest rates, both on the borrower side, it's the cost to borrow, and on the lender side, it's the return that they're getting for lending their money out, right? So when you have an increase in interest rates, it also, kind of correlated to the credit crunch. It incentivizes banks to save money. It incentivizes a lot of people to save money and earn a higher return. When you're saving money, you're not spending it, which is curbing the economic growth, and that's when you see the gross domestic product go down, right? So yeah, that's like what we're at right now. Is especially when the pandemic hit, we kept our interest rates, near zero, in terms of the federal funds rate, and we did that to stimulate economic activity, right? People are borrowing money to spend. Companies are building factories to expand their businesses. It creates jobs. Yeah, so the Federal Reserve is here to make sure we don't grow too fast, but also to make sure that we don't, downward spiral with, because what we've seen in the past, is inflation can cripple economies, it can collapse economies, and it can vastly affect the quality of life for its citizens, right? You think, the law of economics with supply and demand, it holds true throughout an entire human history. So, Germany, when they lost World War I, printed a whole bunch of money for the reparations. It completely devalued their currency. Zimbabwe in the 2000s had a lot of political unrest. They printed a lot of money. It devalued their currency, and that's hyperinflation, right? So in America, we have the universal benchmark currency in the US dollar. We have the strongest economy in the world. So, we can print a lot of money and not see the type of inflation that a smaller country could. Argentina, Venezuela right now, the political unrest down there, they're seeing 50% inflation year over year for the past few years. And we're sitting here saying, oh, 8% is gnarly, because that's what, we're not used to that. But just to put other things in perspective, I've been talking about inflation since I graduated in 2010 with the undergraduate degree in finance. And it's did the CPI numbers and everything kind of stay a lot more under control than I thought they would over the past decade? Like, absolutely they have, but right now we're starting to see that, even though we're the United States, the laws of economics, we're no exception to that, right? So it's a very uncertain time right now. There's a lot of negative outlooks for good reason. And one thing investors don't like is uncertainty. They really don't. So, all these things in part has battered financial markets. 2022 obviously has not been a good year. So
Definitely, I can attest to that. I can attest to that. So
yeah,
I appreciate so much. I appreciate you so much going over all that and really giving us a more in-depth understanding of how the macro outlook works, and the moving parts that really take control in these types of situations. So I guess my, obviously the next question that any person would or should have would be like, what is next? What can we look forward to? What can we, maybe not what can we expect, right? We don't know what to expect. You need to expect the unexpected. But with everyone being so bearish, with recession looming, with inflation where it's at, with interest rates continuing to rise, with Powell signaling that they're still technically hawkish. He did say he doesn't expect 75 basis point raise to be common, but I mean, that's not, when you think about it, that's not really saying anything. I don't expect gas prices to continue to go up by 10% to be common, but just because it happens,
Yeah.
oh well, it's uncommon, but it happened. So I guess, like, what do we, as if you could you give me maybe just your outlook on a bearish case as well as a possible bullish case, or if you want just one or the other, or both?
Yeah. Well, the bearish case is kind of what's on the forefront right now. You talk to a lot of inexperienced people all the way up to the most experienced people that have, lived through these cycles of the economy, right? There's a lot of uncertainty out there. So, in terms of investments and things like that. I mean, personally, I hate to say this, but I always tell people that dollar cost averaging into something that you think is going to be here, 5 years, 10 years from now, stock market wise, I guess crypto. If you think something's going to be here 5 years from now, then that's a more exceptional case. But I don't think dollar cost averaging into those is necessarily a bad thing, because a lot of people believe that a lot of the negative outlooks, it's baked in, right? A lot of things are priced in. If you just go and buy in equal increments, you're going to get an average price, and eventually those things will rebound as U.S. history would tell, right? But there is a lot of negativity out there, and also we've seen stocks crash. By 20%, 30%. Some of these big companies, Netflix, 70%, for whatever the reasons are. And so a lot of people did lose money. But the one thing, especially with crypto, the past year and a half, is that there was a lot of gains to be taken out. When you look at something like the S&P 500 or the Dow Jones, like those are still, for the past, ever since 2009, 2011, those things have been going up. Right. So if you want my personal opinion, like, is there a lot more room for these things to go down? Like, absolutely there is. And, I don't want to sit here and sound like a perma bear, because I'm not. I was more like coming out of college. I was going for the school for finance in the late 2000s. My professors would come in, upset at what was going on every day. And, that reflected off to me. And you found out about all the madness that was going on at that point, right? So, I could sit here and say, oh, we're in another housing bubble, we're in another, a stock bubble, we're in whatever bubble. All these asset prices are up over the past decade, for whatever the reasons are. And, does it seem like we're kind of in a similar spot as we were, before the housing bubble popped in the late 2000s? Like, for sure, there's a lot of similarities there, for sure. But, history never directly repeats itself. It usually just rhymes. And, I could sit here and say, yeah, all these markets are overpriced. But the $1 million question would kind of be like, oh, well, when is this all going to go down? Because if you want my personal opinion, I think a lot of the issues that got us into the havoc in the late 2000s were never directly addressed. And it's not like they were easy to address as a population, or as a
It seems like it was kind of swept under the rug, right? Like they were just kind of like,
sure.
instead of actually dealing with this, let's just put it off to the side. I mean, like, and like you were saying previously, like the chance to take profits was there. I mean, we hit the S&P, I believe, hit an all-time high January 7th of 4,677. So,
Yeah, 4,000.
oh, sorry, my camera was messed up trying to fix it there. So, the profit-taking chance was there, but a lot of people just kept getting greedy and didn't want to realize it. So, and we've seen that this leveraging unwinding. This is kind of one of the last things I wanted to really touch on, was this unwinding of leverage. So in the crypto world, The Luna collapse led to the Celsius collapse, which is leading to the Three Arrows Capital 3AC collapse, and that's called Contagion. I had trouble with pronouncing that. So I wanted to touch on if you could kind of lend your experience to any previous times Contagion has really ran wild, or your experience towards just leverage in the market in general, and what happens when there's a general unwinding of leverage.
Yeah. So I do want to point out, we were talking about the fractional reserve banking earlier, and the last thing you want to have is complete panic and a lack of confidence in those financial institutions to the point that everybody runs to the bank at the same time to try to get their money out, which is impossible, right? What happened with Luna, and this is what happens in negative markets conditions, right? Is that Luna had a digital bank run on it, right? And a lot of that is you could have looked at the Anchor protocol and said, oh, they have, UST. You can take your money, put it in there for 19.5%, right? I think Luna, towards the end of it, was footing a interest payable bill of over $7 million a day, because there was people that were dumping their life savings in here. There was institutional money in here. And the way those types of platforms
A lot
work,
of institutional money.
a lot of institutional money, which is not good for crypto. So my guy Charles Hoskinson has been saying this for a while, is that when there's a lot of madness in there, right? You have a lot of people doing exercising irrational exuberance, and people kind of flock into there, and they break the number one rule of crypto in general, which is what? Never put more money into there than you're okay with losing, and all of it. And Luna was a big one because this is a top 5 crypto at the time. This is billions and billions, dozens of billions of dollars worth of a protocol that kind of collapses overnight. So, it kind of, between the Luna and the Celsius, and all these things are kind of having this chain reaction, right? It reminds me of the investment banks in the late 2000s, right? So if you remember that the housing bubble, the day that it truly crashed was in 2008, September 2008, I believe, is when Lehman Brothers filed for bankruptcy. Well, before Lehman Brothers, it was Bear Stearns. Bear Stearns had a government, JP Morgan and the government worked out a government-backed guarantee for Bear Stearns to be purchased by JP Morgan. Before that, it was Merrill Lynch. The government helped Bank of America purchase Merrill Lynch for sweetheart deals, by the way, but because these banks were too big to fail, because all these banks are doing business with each other, all this money is interrelated from institution to institution, from country to country. Modern day finance is the world's flat, right? But why did the most basic thing you can kind of point to is negative market conditions kind of led these institutions to realizing how insolvent they really were, right? So I think what what you're seeing, so with Three Arrows going on right now, it's absolutely, it's negative market conditions that are pulling out the true structuredized ugliness of these protocols, right? So who knows what would be next, right? Like, there's been a lot of talk about Tether not having a true one-to-one collateralized backing of dollar issues versus what's backing what they're issuing, right? And especially if that's being backed by other crypto assets that are going down too, then that's not good. And that's kind of what we saw with Luna as well, as an algorithmic stablecoin. But they did purchase a bunch of Bitcoin and other assets to kind of back it. But you had these, Bitcoin's falling and Luna's falling and everything's falling, right?
And not only that, you also have a lot of that is on chain. So with the on chain transparency, there is a chance to attack people, right? If I know that, if I'm a whale and I know that you have a big position, and I see that big position is close to getting liquidated, like, I might be able to short the market, attack that specific position, knowing that you're going to have to sell other things to cover that position or whatnot, or even cut that
100%.
position. So I think there's definitely some of that going on in the market as well. So, um,
Yeah.
but
There
but
was a lot of
yes,
talk about that with Luna. There was a lot of talk about the manipulation and the opportunity for someone to kind of attack them. And so you're right. That's we've seen that in traditional finance too. But you're right. On the blockchain you can kind of pull it up and anybody can see it. It's very interesting for sure.
yeah. So all those things have carried over as far as the crypto market is concerning. So there's a little bit of doomium, gloomium, whatever you want to call it, in the markets right now. Danny did lay out, the what was the bear case. Well, the bear case is kind of what we're facing right now. Continued interest rates being raised, continue market sell-offs from forced sellers, right? So forced sellers is people having to sell out of their positions before they get liquidated, or you'll have people trying to add to their positions like Celsius. But you have some of these bigger player whales in the game, or institutional money as they call it, that are losing their shirt, so to speak. Losing their shirt. They're
Yeah.
definitely taking a bath. Taking a bath in the market. So,
Yeah,
um,
I will say in terms of the macro case that we're all interested in because everything's kind of intertwined, right? Like we all know that like Bitcoin and all the crypto, like they didn't lose 80% of its total value because it's bad technology, right? Like there's macro conditions that are affecting these things. It's the same thing with the stock markets, right? A lot of negative perception and a lot of things are starting to come out worse than what the entire market, which is comprised of extremely smart people, were expecting, right? So continue to look at inflation numbers. Obviously, we're going to all have our eyes on the interest rate hikes. Those are kind of like the bread and butter in terms of like the public figures, right? But in terms of like us going into a recession and having like an extended period of contractual economic activity, which will affect the stock markets, it'll affect the bond markets, it'll affect the crypto markets, housing markets, everything, right? You definitely want to look at, other macroeconomic indicators. Unemployment's a big one. Um, and so you just want to actually like kind of be very in tune with what the overall economic news is right now, right? That's the big things that are going to be guiding all of the financial markets. And to pull out a bull case, since you asked me about that, is you got to keep in mind that what we're kind of experiencing right now on the scale in terms of all the debt that's out there, it's at an unprecedented level. And we've never been really tested as a country, as an economy. We've never had national debt higher than a yearly gross domestic product, which we've now had over the past few years. There's a lot of things. We're in unprecedented territory, and you got to remember that we might not um, we might not oh shit, I lost the train of my thought because you were asking me about the leverage. But the
no
government doesn't
worries.
want the music to stop. The government doesn't want the music to stop, right? So if we can do things through all quantitative easing or whatever all these economic monetary fiscal policies are to kind of continue to get us on a bounce back, I mean that's very possible. It's just there's a lot of uncertainty about if that's, when that would happen, in terms of a fall to the downside or a rebound to the upside. But in terms of leverage, I'm glad you actually brought that up. So leverage is I'm going to keep going back to the housing crisis, right? Because that's the most recent example of us going into a recession and kind of an economic collapse that we've had. And I kind of lived through that, right? So you got to keep in mind that leverage is very, very risky, and it's really when you get down, it's like when things are going great, people are going to borrow a lot of money. They're going to borrow it to invest to amplify returns, right? Or they're going to just have a lot of debt on their balance sheets, right? If they're operating with a lot of debt, kind of like Lehman Brothers was, and they're getting into more and more risky assets, right? Because once all the good mortgages couldn't be bundled and kind of sold to the public, which is what the collateralized debt obligations were during the mortgage crisis. Like once they didn't have bad assets, or once they didn't have good assets and good loans to bundle up and kind of securitize and sell, they started going for the subprime loans, right? And now banks are making money hand over fist, and the mortgage brokers are making money hand over fist. So everyone's making money when things are good, and people start to get a little bit too risky, right? Especially with individual leverage. If that's the types of things that can make these parabolic swings, right? Like you can attribute Bitcoin some of the times it blasts to the upside. It's because it's highly leveraged, right? But then just like that, you'll see a leverage flush where it goes parabolic to the downside. I think that just like in the late 2000s, I think that a lot of individuals, investors, institutional investors, companies as a whole, they've been over leveraged, right? Because debt was easy to come by, right? When people are making money loaning out debt and the standards of obtaining that debt is lowered, right? That can make a booming economy boom even more. But just like it can send it to the upside, it can absolutely send it to the downside. I think that, especially,
and I kind of think that.
What are you saying?
I was just gonna say I think that's kind of what's happening, an unwinding of all this leverage that was pumped into the market by some of the bigger people, right? So some of the institutions that are actually getting margin called, like Three Arrows wasn't able to meet a margin calls apparently. Celsius, they paused their withdrawals because they
were having a bank run. They didn't have the money to give to everybody. Yeah. Yep.
Exactly. So I just think like an unwinding of all the leverage in the market is what's happening right now. I'm hoping that flush can kind of allow us to find a bottom here. As far as like the crypto markets are concerned, obviously the stock market as well, since they've been pretty correlated over the past several years. So yeah, I'm glad you touched on that, just because I just thought it was weighing like heavy on the mind.
No, 100%. I think that what you've seen, because with margin calls, that was traditionally used in stock markets to amplify returns. People have this appetite for risk, and they're able to bring it on, right? So who do you blame? The people that want to take the leverage out, or the people that are giving the leverage to those people, right? I mean, everybody's to blame in a situation like that. But yeah, you've seen some really bad things happen to people in terms of the margin calls, right? Where they can lose their entire portfolio overnight. And once we do start hitting like, a rut in economic and investing activity, you'll see that the leverage will go down. It'll stay down until things start to rebound. But the hope is that, people that, if you're an individual investor and you have all this money in the world to lose, like that's not really a big deal. But when you have banks and financial institutions that are supposed to be responsible with their money, and they're taking these deposits in and they're doing extremely risky things, over levering themselves, right? That's not good, right? And then you also, if you have, especially in Bitcoin, and it's cool because it is all on chain, and you can start to see like truly these numbers can't really be manipulated. That's the beauty about it, right? Is because numbers don't lie, people do, and the blockchain does tell all, right? And you see these huge funds get into Bitcoin, over lever themselves, and that's the reason that Bitcoin can fall 40% overnight. That like it's nothing, right? A lot of that is over levering, and it's just like a short squeeze. A lot of times it causes more dramatic price action because people do have to cover their positions, so they have to buy to cancel out their position, which kind of sends it even more to the downside. So yeah, I think that a lot of the same things that got us into trouble 13, 14, 15 years ago haven't truly been not just addressed, but they were allowed to kind of start happening again, right? And yeah, we're living it like,
and that's where we're at.
Yeah, 100%. It's
definitely
and that's
Go ahead. Sorry, it's definitely what?
No, it's definitely interesting times, and like I was saying a little bit before, it's unprecedented territory. The scale of what we're at, right? I mean, $700 billion, of a bailout of the banks in 2008. That sounds like at the time that was unfathomable, right? But if we get into the same situation 6 months, a year down the road, God forbid, that's going to make $700 billion look like it's nothing. And I don't like to say this because this affects.
And remember,
all of
everybody,
us,
this
right?
is Danny's bull case. Remember, this is his bull case.
Yeah. It's. I mean, when you put it this way, if you want to go as easy as looking at like the S&P 500, look at what it was in 2012, and even with the 20-30% fall this year, look at where it's at. Well, the S&P hasn't fallen that much, the Nasdaq, right? But look at any of these major U.S. stock indicators over the past 10 years, and look how much value there still is compared to then, even with the drops. And you'll see that, yes, there's still evidence that these markets are being propped up through Federal Reserve policies, right? So can it go down? Absolutely. And right, up between upside, downside, comparing those two, I would say, yeah, absolutely. The downside is a lot more apparent than the upside is, right? It's tough to find the bull case right now. I'm not saying it's impossible to make not to make money by investing in things like besides just going short or whatever, right? There's still going to be opportunities out there, but yeah, in terms of like macro trends and like where we're at right now, yeah, there's a lot of things that need to be fixed, and I think Jerome Powell and the Federal Reserve, they're not being shy about it now, right? Last year, they were telling markets that inflation was transitory. Like whether you believe that or not, it turns out inflation is temporary.
Just to give people an idea, back in, let's say, October of 2012, the Nasdaq was $20.34. That was its low in 2012. The low was about $20, and so it's up about 600%. Still,
Yeah.
So just to give some
100%.
interest there, and then also like even if you take the highs from 2008, we're still up 200% from the highs of 2008. So, if your kind of theory is correct, they're not theory, but just kind of your thought process plays out, where even back then in 2012, you thought there was still a long way, to go in fixing things. Imagine being up 600% from that.
From that, exactly. Yeah, and a lot of people were asking me, why are you even worried about inflation? Because things were fundamentally still incorrect in my mind, right? But the strength of the U.S. economy, or whatever the reasons are, like we didn't see inflation quite like I thought we could have, but we sure as hell are now, and it's not like I enjoy talking about these things. I know people's retirement funds, the 401ks, your pensions, they're all tied into the equity in a lot of these huge American companies, and I know that there's individual investors that have lost their entire life savings, and or if they haven't lost them all yet, they very well could, seeing how things unfold, into the near future. It's not like these are things that are fun to talk about. And I certainly hope that somehow we can kind of have a rebound and turn this around. But, history has shown that economic activity is definitely cyclical. You go through the downs, you go through the ups. And that's just the way it is, right? That's why, it's pretty important if you're investing for the long term, not to panic sell. This is what I was talking about with like dollar cost averaging in earlier, just getting an average price over time for something you think is going to be here for the long term. That's always going to be a good strategy because, I guess in Bitcoin's 13-year history, it's shown that it's rebounded. And
pretty well too.
Yeah, and American stocks throughout their entire history, it's shown that it goes up, it goes down, it goes up, but the long-term trend is that it does go up, right? So, I hate to I don't want to scare people away from anything, but I do think there's a lot of macro factors that need to be paid attention to for sure. So and
Yeah, man, I
Wall
appreciate it.
Street.
I appreciate you giving all your insights in regards to the macro factors. I enjoy looking at the macro picture. I enjoy trading, right? I enjoy the day trading and the excitement from there, but I also enjoy looking at the macro picture and kind of getting an idea of where we're headed. Looking at macro trends and it's when it comes to technical analysis always gives me a better outlook of kind of where things are headed. And there was a point, right, back in like '09 where inflation was actually negative. Was that correct or is that
Yeah,
incorrect?
well, like, yeah. So there's been periods in U.S. history where we've seen definitely, negative inflation for a short period of time. It's possible. I think I actually have an inflation chart too. I don't think you can pull it up, but I was actually looking at this earlier. So yeah, usually
If you
it's
might be, you can share your screen if you hit the share at the bottom.
okay. Let's do this. Share right here. Share screen.
Share screen, and then if you go all the way over to where it says Chrome tab, it says share. It says share screen, and then it says like window, monitor, or Chrome tab.
Yeah, yeah,
You can
I
actually
got it right here. Okay, cool. So yeah, we can look at this one right here. This is it's from the Wall Street Journal. So this is U.S. inflation from literally the United States, the existence of the United States till now. And this is just the annual percentage change of the consumer price index, right? So you can see that there's we haven't had it for in terms of yearly, right? Yearly CPI. If what you were referring to in 2009 was maybe like a short period of time, we might have had it. Like
Yeah,
one of the
it was
months
only
in
like
here,
it was like four
right?
months.
Yeah, it's certainly possible. But if you look at the dates where we've actually had negative inflation, you'll see that this is actually correlated to like major events in our history, right? So we kind of have like the Civil War over here. We have World War I over here, World War II over here. So for whatever the reasons are, you can absolutely have negative inflation. It's not common, right? Because generally over time, the economy is growing at a particular pace that will cause either very low inflation or very high inflation, not usually negative inflation. But yeah,
Got
that
it.
I definitely thought that was interesting. I do have a couple other graphics right here. This is actually the 10-year. I believe this is the 10-year. No, it's the 1 year.
Um,
This is the
you
1 year
have
Treasury.
to.
Oh,
I'm sorry. You have to go ahead and remove it and
oh,
then
and do
do
it
that same
again.
process. Yeah, it's a little annoying in that sense, but you know, this is the time where I can remind you that please like, share, and subscribe if you'd enjoyed this macro talk. I try not to be too corny and bug you guys with that too often, but I am more of a little guy and I try to bring as much value as possible. So if you could hit the like if you liked it. If not, don't worry about it. Hit the subscribe if you are interested in more macro talks or talking anything about crypto and the economic outlook in general.
I
And
love it.
we greatly appreciate it. We greatly appreciate it. So,
Let's do this
Danny,
one
that
right
wasn't enough
quick.
time for you to click. All right, all right. Just
No,
making
no,
sure.
I got it right here, bud. So
Now we're
this is
prepared for next time.
so when you talk about a raise in interest rates, one of the things that's going to be tied to that is bond yields, which in this case of this chart, it's a 1 year Treasury bill, which is the
Oh
United
wait, okay,
States.
okay, okay. This is the learning curve. So, what is a 1 year Treasury bill?
Yeah, so the government to finance their activities, they don't just take in taxes, right? Like they'll issue bonds, right? So
And a
one of
bond
the
is
yeah, and a bond is just debt, right? A
boom.
bond is literally just it's securitized debt. So it's basically if you're buying a bond, you're giving somebody else money that they're going to pay back to you at a later point in time plus interest, right?
Got
So
it.
a bond yield,
So if you're buying my bond, say I owe Jack $100 and I'm selling you a bond, that just means that hey, or I'm sorry, Jack owes me $100. I'm selling you a bond. Now Jack's gonna pay you that 100 plus interest, and you're gonna pay me, let's say, $80 instead of the 100 that Jack's gonna pay you plus interest.
Yeah. So, like, if you purchase the bond, whether it's on the primary or the secondary market, if you're the bond holder, then you're the one that's going to be receiving that money, right? Now, there's corporations that will issue bonds, and then there's governments that issue bonds, and they'll do that to take on debt, so that they can operate and if a company is a more risky, so if it's a riskier company, not as well known, or whatever the reason is, if they're less credit worthy, the bond yields on what they issue is going to be higher, because if there's a risk that you might not be paid back, the investor wants to be compensated for that. So when you look at United States debt, right, the short-term debt is called T-bills, Treasury bills, right? And the longer term bet, anything over a year, is called a Treasury bond. And what that is you're loaning money out to the government, right? Back in the day, these were like physical pieces of paper, just like stocks were, that grandparents might hand over to their grandkids, right? And those are just that's the right to be paid your principal plus interest back, whatever the specific agreements of the bond is, a coupon bond, discount bond. There's different ways to get paid back your interest, whether it's like a periodic payment or not. And then at the maturity date of the bond, you'll get your principal back, right? So these bond yields are directly tied to the lowering and the raising of interest rates by the Federal Reserve, right? So if you look at this historical chart, you'll see that in the 70s we had a bad economic crisis. There was the oil crisis, right? And you'll see that interest rates actually went way up, right? So going into the 80s, think about savings accounts at this time are paying a lot of money for you to park your money in there. Think about mortgage rates. The past 20 years has kind of spoiled a lot of mortgage borrowers, right? Because they're getting these crazy low rates, anything from like 3, 4, 5%, where in the 80s, your mortgage rate could very well be 15, 18, 20%, right? So then you'll actually see from the late 80s till now, there's been this this long-term trend of it kind of going down, right? So you can actually see this is where we're talking about, where in 2009, the federal funds rate was extremely low to kind of stimulate economic activity and try to get us out of the recession. And then we kept it that low throughout the 2010s. It started to go back up again until we hit COVID, and then we left it at near zero again. And now this is what we've seen since 2022, is this dramatic rise right here. So the expectation, like my personal belief, is that this will continue to go up, and it will continue to negatively affect financial markets. So yeah, the Fed adjusting the federal funds rate affects all different types of interest rates on debt, right? So yeah, that one was interesting right there. Though the one thing I do want to say, and I thought this was interesting because I actually wasn't quite correct about this, is that in 2021, when we were starting to, there was a lot of programs between, all the stimuluses, all the stuff that we know about the Federal Reserve printing money throughout 2020. Our economy actually recovered a lot quicker than we were expecting from the pandemic. And that kind of stimulated activity, economic activity, and inflated asset markets like we've never seen before. So, when Bitcoin was specifically going up, if you think about Bitcoin at its core, it's like the anti-dollar in the sense that, the U.S. dollar is a fiat currency and there's an endless supply. It's what the Federal Reserve actually, and the government, collude together to kind of like, to create more money or what have you. With Bitcoin, we know that when it's all said and done, there's only going to be 21 million, right? So what happened was I would talk to people and I would say, well, this negative inflation talk, yes, like, is it bad for economic markets, right? Yes, I mean, it is, but maybe Bitcoin is this digital gold. Gold is thought of as a hedge against inflation, right? It's this universally accepted precious metal. It's a commodity. It's a real
Right.
asset, where a dollar is a paper asset, right? And I was like, Bitcoin could very well be digital gold, and this is the hedge against inflation. And all this talk about the damaging and the weakening dollar could actually prop Bitcoin up to, whatever the numbers a lot of people were saying last year, whether it's 70, 80, 90, 100K, whatever. I was like,
Right.
that's certainly possible, and that does make sense to me. But what I didn't necessarily account for was that the inflation talk with the rise in interest rates, that triggered a sell-off in the stock markets, which made the stock markets go down. But it triggered an even bigger sell-off in the crypto markets, because the crypto market in times of panic is just another liquid market that people will sell assets into. It's a lot easier to sell crypto and stocks than it is, your car or your house or your collectibles, and you know what I mean? So that's traditionally,
Exactly.
I didn't
Your
think it was going to
Pokemon
be nearly
cards.
as correlated. I didn't think the stock market going down was going to be as correlated with crypto going down. And, like it was unprecedented times in terms of that. And it unfolded a little bit different than how I thought it was, right? So I wasn't really confused what happens, and why it happens. I was wrong about, I was wrong about how the reaction to what was going on was going to kind of unfold, right? And in investing, that's enough to make you lose a lot of money. So, it is what it is. It's definitely important to take profits, and, when they're there, right? It's a lot easier said than done. I mean, we can all get a little bit greedy or what have you, but yeah, this interest rate talk the past 6-7 months, whatever, has definitely, got the good feeling of the stock market and the crypto markets. It definitely took that away for sure. So things are a little bit more rational and real right now in terms of investors' expectations. And yeah, that's why a lot of people are Googling recession and things like that right now. Yeah, it's for sure. It's definitely interesting times. So we'll see.
It definitely is. It definitely is. Well, I mean, that was absolutely phenomenal. Let me give you a hand, man. I really
Thank you.
commend you, and thank you for coming on and like sharing that knowledge. And we have these talks often. Like, we'll go on 3-4 hour phone calls when we were just calling to, ask someone a quick question where me and you will just get to go. And so I appreciate you coming on and sharing those talks and those experiences. And possibly we make this into, once a week or every other week or something if I can get you free. But if not, we appreciate the
Absolutely.
time that you had. Hey,
Oh,
okay, all right, y'all heard it here. I'm gonna hold him to it.
yeah. I'm willing to rant. I'm willing to rant about anything. I'll try to stay on as best on topic as I can. But if I don't, hopefully I know you'll.
It's cool. I'm working on my editing skills in the back anyway, so that way I can chop some of this down for us. So,
Yeah,
all
yeah.
right. So if you guys did get a chance to learn something and gain a little bit of knowledge here, or at least enjoyed the perspective, drop a like, drop a follow, drop a subscribe. You can find Danny's Twitter. Is it still Hammer Time G-Man? I hope so. That's what I've been telling
I
people.
I believe it is. Yes, it is. Hammer time.
All right. Hammer Time, G-Man. You can find him on Twitter. There. What's your Is that the same for Instagram?
No. Instagram is going to be Hammer Time Gibson.
So Hammer Time Gibson and Hammer Time G-Man. So you guys
There you
check
go.
Danny out, man. Give him a follow. He definitely doesn't mind sharing his opinions with the world, and whether you love it or whether you hate it, he does keep it
Yeah.
real. So I appreciate you guys checking in. Any closing thoughts or final words from you, my man?
No, it's everyone, be careful out there, and I can definitely say that, the biggest, the biggest defense against this world, is a thorough knowledge of it. So, never be afraid to dig
Ooh,
in and learn something. Yeah, absolutely. In this day and age of
that's a
smartphones,
flex. Tell him.
yeah, 100% for sure. It's I had a very smart professor tell me that, and I kind of always remember that. So,
Nice.
yeah, you got to keep in mind, especially in investing, you're going up against, other smart people. And if you're not willing to learn, I promise you, they are, and it's important to
Someone else definitely is.
try to stay at least a step ahead of what you can at all times. It pays to be early. So
Yeah, in the crypto markets, you don't have to be the fastest, but being faster than the other guys and being earlier than the other guys definitely helps. So get up early, get up often, and get after it. All right, my
yeah,
brother. I'll talk to you soon. Appreciate you.
no problem. And if it sounds too good to be true, it probably is. So
Boom,
yeah,
baby.
60